Today, we're going to discuss one of the most important financial topics for every beginner investor, the emergency fund. What it is, why it matters, how much you should keep, where you should keep it, and why it should always come before stock market investing. Most beginners get excited about stocks, trading, and making quick profits.
Yes, President! Yes, it's storm now, warning!
It begins with protection. That protection is called an emergency fund. An emergency fund is money that you keep separately for unexpected situations, like medical emergencies, job loss, urgent family expenses, car repairs, or sudden financial problems. This money is not meant for shopping, entertainment, or daily spending. It is reserved only for real emergencies. You can think of it as your financial safety shield. Now, many people ask, why is an emergency fund so important before investing in the stock market? The answer is simple. The stock market is unpredictable. Sometimes markets go up very fast, and sometimes they crash without warning. Imagine this situation. You invest all your savings into stocks, and suddenly the market falls 20 or 30%. At the same time, you face a medical emergency or lose your job and urgently need money. You will most likely be forced to sell your investments at a loss. Not because your investment is bad, but because you need cash immediately. This is exactly why emergency funds are important. They protect your investments from emotional decisions and forced selling. Point number 1, protection during market crashes. If markets are down and you already have emergency savings, you don't need to touch your investments. You can give your portfolio time to recover. Point number 2, mental peace. This is delicious, honey.
Yeah, Mom, it's great. Can I have some more?
Of course, sweetie. Great job, everyone. Financial stress affects decision-making. When people don't have emergency savings, they panic more during difficult situations. But when you know you already have money set aside for emergencies, your mind stays calm and focused. That peace of mind helps you become a better long-term investor.
Point number 3, financial discipline.
An emergency fund creates a strong financial foundation. It teaches patience, planning, and responsible money management. And disciplined investors usually survive longer in the market than emotional investors. Most financial experts recommend saving at least 6 to 8 months of essential expenses. The goal is simple. Even if your income stops temporarily, your lifestyle and basic needs should continue without stress.
Your emergency money should be easily accessible, safe, and low risk.
If you use emergency money for any serious situation, make rebuilding it your top priority. A good health insurance policy adds another layer of financial protection. So remember this simple formula. First, build protection, then build wealth. Before chasing stock market profits, create a strong financial foundation. Because when your emergency fund is ready, you invest with confidence, patience, and that wealth is truly created.